of Carlisle writing this: the cost of rebuilding and recovering from the Hormuz shock will be enormous and underscores the regime change towards physical assets. Jeff joins us now for more. Jeff, welcome to the program. It's always good to catch up with you, sir. Fluid environment, so allow me to go through the headline of the last 5 or 10 minutes or so. One headline, one report coming from Iran that their energy assets have been struck. Now, I have limited information beyond that, but Jeff, from your standpoint, in the week since we last spoke, has this got worse or better?
Worse. I like to call it molecular contagion. Last week we were talking about shortages in Singapore. Prices of jet fuel spiked to $230 a barrel. This week, it's in Rotterdam. Rotterdam's $220 a barrel. Thailand, Philippines, New Zealand, Australia. So this thing's going intercontinental. And so you look at Singapore, Rotterdam, the spread, there's no more price spread, there's no more spare barrels, there's no policy fix, and it's just physics at this point. And I want to emphasize, these are physical supply chains, and that the idea of around financialization and the ability to print money doesn't apply here. And I think the title of that piece says it all. You can't print molecules.
Jeff, with that in mind, where and how do you think we're underpricing this risk still in financial markets?
That's the peculiar thing about this, is that you look at the paper markets, they've entirely disconnected from the physical markets. Crude oil on an Oman basis, on the other side of the strait, the side that's free, spiked to $173 a barrel yesterday. Crude delivered in Asia is a blend of Dubai and Oman, which is trading somewhere around 130 and 170. And today, this morning, they're call it 120 to 150. So you're delivering crude into Asia at somewhere around $130 a barrel. Product prices are spiraling above $200 a barrel. So the disconnect is between the paper market, which is sitting around 100, and the physical market, which is showing a very different environment.
Jeff, some people have speculated that's because of certain types of manipulation in the futures market, and that's the reason why you have seen this gap blow out. Do you think there's credence to that?
You could argue that Monday last week, there was a mysterious 11 million barrel seller. I don't want to get into that. It's not enough to really change the dynamic. I think that the bigger factor that was likely driving WTI and Brent and staying lower is the price of Urals, Russian crude oil. It's rallied $65, $70 a barrel once they took off the sanctions. So WTI and Brent were the high-cost barrels. The Russian was the cheap. What happened? You closed that gap. And now that you've closed that gap, you don't have any more spare barrels in the system, and this rest of the complex likely to start to rally. I go back to the point that John started with is, we're dealing with an enormous supply shock. And by the way, the supply shock is almost equal to the demand shock during COVID, and we know what that did to global supply chains. So I think at $100 a barrel, this thing's mispriced. Even against the physical market.
There is a sense, though, that this time is a bit different than, say, the 1970s in terms of the world's reliance on oil, especially China, how much they've diversified to electric vehicles, to nuclear energy, and other places as well. How much do you think that that is going to be the growing trend, to diversify the sources of energy in myriad ways beyond what we were doing, even during the so-called Green Revolution, as people try to avoid these types of shocks?
Well, I absolutely argue that the renewables, nuclear power, are born out of the 1973 energy crisis, and this is going to unleash an enormous amount of investment into renewables, nuclear power, and other localized energy sources. The problem, though, is we call this the new dual order. The problem is that we haven't got to that transition where we have electrified everything, localized it, and the type of oil consumption that's left in the global economy is critical. And so if you pull those barrels out of the system, the rippling effect or the cascading effect through global supply chains is going to be significant. You go from gas to urea, urea to fertilizers, fertilizers to the dinner table. Or you go from LPGs to synthetic fibers to cotton. You switch out of soybeans and corn into cotton. By the way, I think the best sector to try to get value in right now would be agriculture, because it hasn't priced it in.
Jeff, when it comes to barrels coming off the market, this came from an industry consultant in terms of China. They're looking at potentially a drawdown in commercial and operational stockpiles amounting to as much as 1 million barrels a day. That can happen over the next 4 to 6 weeks. What would that mean for the price of crude?
I think the key point is once you exhaust those inventories, there's nothing left. Think about it this way. You have demand up here, supply down here. Once those inventories are exhausted, boom, you have to bring demand down in line with supply. And to do that, you're going to need prices far higher than where we are right now. I like to do the mirror image of COVID. Let's go back to COVID. It was the exact opposite. You had a situation which you had demand up here and, or excuse the other way, you had supply up here and demand down here. And so what happened? The demand collapsed. Eventually you filled all the inventory capacity in the world and you had to bring supply down and demand immediately. What did that require? A minus $37 a barrel price to create that rebalancing of supply and demand. Now we have the exact opposite environment. So just imagine what it's going to do to require that reduction in demand to bring it in line with supply if it took a minus $37 price to create that rebalancing back in 2020.
So, Jeff, I'm going to ask you the question. What would it take? What's the opposite?
I'm going to stick to the same answer I gave you last week. You get long, buckle your seatbelt, and hang on for the ride. We'll know when we start to get to that point where the system starts to rebalancing. But I want to emphasize, don't underestimate the type of volatility. If you take European gas in 2022, we saw Russia cut it. And by the way, the market ignored it in June of 2022. By August and September, you were at $300-400 a barrel. Do you know where prices were in December of that year after you destroyed so much demand, they went negative. So I'm not going to say oil's going negative, but what I'm trying to tell you is it's going to be a really bumpy ride. You've seen no evidence of demand destruction that rebalanced this market yet. So we haven't even really started the rebalancing process yet. So the upside here, I would argue, is substantial. Again, we want to be long. And I look at the market. It's shorting energy stocks and getting long everything else that is short energy. I think you're picking up pennies in front of the steamroller right now.
Jeff, we buckled up. That's why we have you on again this week. Can you give us a range of how high, though, prices could go? I know you don't want to give us an exact definition of where you think Brent oil is going to hit, but give us a range of when you say get long. I mean, how long are we talking?
But look at Oman's already traded at $173 a barrel. Jet fuel in Rotterdam is $220 a barrel. In Singapore, it was $230 a barrel. And we haven't started the rebalancing process. All we have seen is what happened in places like Thailand and China hit export bans that then create ripple-on effects and shortages. Then you have the hoarding that begins to take place. You're $8 a gallon gasoline in Los Angeles right now. So, you know, the upside here, again, I don't want to speculate on how high, but you've already witnessed something like 173 in the physical market. So that's my point here. There's a massive disconnect between the physical world and the paper world, and the paper world includes the financial world. You know, I like to point out it was in January of 2020 when COVID hit. I remember I was looking at the what was going on in China. It was the second largest economy in the world just shut down. Stock market rallies, oil is hanging in there, not selling off. And I'm going, guys, we got to get short this thing. You can't hit the global economy with a shock of that magnitude and not expect bad things to happen. And we have the exact mirror image of the same similar size shock hitting the world right now. And the market on the paper and financial side is not keen off the signals that it's providing at this point in time.
So, Jeff, at some point it gets real for the market. And with COVID, it was when the northern Italian cities started to shut down. There was a sense that this was getting real, that it was spreading beyond China, it was hitting Europe and could hit the US as well. What makes this get real? What closes the gap between physical and paper markets?
I think it has to be visual images of real shortages in the United States and in Europe. Now, the U.S. will be hard, particularly if they do export controls on that. Europe will likely be the first one to hit. And I think the implication here is the U.S. believes it's safe because of energy dominance. And this is the point I made it last week. From an equity market perspective, that equity market in the United States is a global market. All of those Mag 7 companies earn their earnings in Europe, in Asia, and all over the world. So when this energy crisis begins to hit places like Europe, it's going to impact the earnings of those companies that sit inside the U.S. because the U.S. equity market is not a U.S. domestic market. It's global, so it'll feel the impact. And I think that if the Americans are going to feel it first on the wealth impact before they'll ever feel it in the at the income cash flow level. The Europeans, unfortunately, they're likely to feel it at both sides relatively soon.
Jeff, it's good to see you. Thanks for making time for us again. We'll catch up soon, no doubt. Jeff Currie there of Carlyle. A few headlines there, of course. One, you cannot print barrels. And two, even at 100, this is not pricing the shock that he sees playing out.
Yeah, he sees it in the physical market, and he says that it's only going to get worse until you get lines lining up to get energy. That's going to be a problem. He also said something about agriculture, and I think that we cannot overlook this. The idea that 40 to 50% of the world's urea, which is a key ingredient in fertilizer, is being withdrawn from the market right at the same time that you would have a planting season is a reason why I think a lot of people are watching with concern the world's food supplies.
Jeff Curry is a breath of fresh air for the people who continuously message me and